18.1 is talking about short-term debt financing. Two learning objectives. Identify the available sources of debt financing and journalize transactions related to short-term debt financing. So first bit is just key terms. The payment of an operating expense necessary to earn revenue is called a revenue expenditure. Obtaining capital by borrowing money for a period of time is called debt financing. A bank loan agreement that provides immediate short-term access to cash is called a line of credit, or could be called a credit line. And then the interest rate charged to a bank's most creditworthy customers is called the prime interest rate. So in our transaction here, it says on November 14th, drew $15,800 on its line of credit, receipt number 912. So all we're going to do here is we are going to receive cash. So we're going to increase our cash with the debit for $15,800, and then we're going to increase our line of credit for $15,800. Since we're receiving cash, that's going to go into our cash receipts journal. So we're going to debit cash, credit, line of credit. Signing a promissory note for an extension of time. So on September 30th, Sun Treasures signed a 60-day 12% note to Haas Incorporated for an extension of time on its account payable, $4,200, memorandum number 142. In this case, what we're doing is we're moving it from the accounts payable. So we're actually going to decrease our accounts payable account by $4,200, so they don't have that accounts payable anymore. But we're going to transfer that into notes payable. So we're going to decrease accounts payable and increase notes payable. Now, with that, we also have to decrease our accounts payable ledger, which would be under Haas Incorporated. Because remember, accounts payable and the specific account are going to go together. Okay. So in this case, this would go into our general journal. Notice we have our slash in here for accounts payable / Haas Incorporated. We're going to debit that for $4,200, and we're going to credit notes payable for $4,200. A couple more terms here. Interest that's incurred on borrowed funds is called interest expense. And expenses that are not related to a business's normal operations, those are going to be non-operating expenses. So those are things like expenses that you wouldn't need to actually make that business continue running. On November 24th or 29th, it says that we paid cash for the maturity value of the August 30th note. The principal was $4,200 plus interest of $84 for a total of $4,284. Okay, now here they're showing us how they're going to get that interest amount. In this, they actually give us the interest amount, but in sometimes in your working pages, you will actually have to figure out that interest. Okay, so we're going to take the principal amount, which was $4,200, times the interest, and the interest they give us back a slide, or two, I think it was. So that interest was 12%. Now we have to figure out that time as a fraction of a year. So we had 60 days. It was a 60-day note. So we're going to take 60 over 360. Remember, in accounting, we use 360 instead of 365. And that's how they came up with the $84. Now, they're paying cash for that notes payable, so they're going to decrease that notes payable of $4,200. $84 is going to go to that interest expense because they had to pay for the interest of that note. And so that means that a total amount of cash of $4,284 was paid, so that would be a credit to cash. Since we're paying cash, that's going to go into our cash payments journal. We're going to credit cash. Notice it's this top one here. We're going to credit cash for $4,284 and then debit notes payable and interest expense. All right, questions at the end. I do want you guys to make sure that you're thinking about these questions. Number one, what information is specified in the loan agreement for a line of credit? A loan agreement specifies the maximum amount that can be borrowed, the interest rate, the term of the agreement, and then the repayment terms. Number two, on a line of credit, how would an interest rate of 3% over the prime rate be stated? We would state that as prime plus 3%. Number three, is interest expense an operating or a non-operating expense? That would be a non-operating expense. Interest expense is not something that we need to run the business. Okay, so non-operating. Last one, number four. Where is interest expense listed in a chart of accounts? Since it is a non-operating expense, it's going to be listed under other expenses. Okay, that ends 18.1 lecture, so go ahead and watch the video for 18.1 work together.